Hi, everyone. My name's Andy. I'm from the Finding Value Finance channel. I'll be your host today. I have an interview with Lyn Alden. She is an analyst. She's got a lot of very good macro environment type outlook stuff that I'd like to dig into. So thank you for being with us, Lyn. I appreciate it.
Thanks for
And
having me. Happy to be here.
I'll start with, tell me a little bit about your background and how you got interested in finance.
Sure. My background actually came from engineering. I started investing when I was a kid. Basically, I had little silver and gold coins. Then I graduated into equities. But when it came time to go to university, instead of going into finance, I went into engineering because technology was my other key area of interest. And so I worked initially in the automation industry and then shifted into aircraft simulation and research. My background was in the electrical engineering area, but because I wanted to, get more into finance as well, I began shifting into engineering management and running the finances of an engineering facility. And eventually I retired from that role, even though I liked my work there, to focus on kind of my original passion, which was investing. I kind of took the quantitative background that I had from that and started Lyn Alden investment strategy to focus on multiple different asset classes. So, there are, say, some people that focus on growth stocks, some people focus on gold, some people focus on value stocks. I tried to gravitate and focus on whatever is kind of compelling. And I think it's one of the few areas kind of left, a lot of alpha is kind of squeezed out of the market by machines and by tons of research. And one of the few ways that I think is still kind of available to investors is to kind of rotate and kind of get ahead some of these really big capital rotations and going to areas that are, underloved and looking for catalysts that might make them start to come into capital flows again. In addition, I focus on really long-term cycles, and so generally I find that especially in this sort of macro-heavy environment, kind of a very weird environment, history books are some of the best guides we have for how to navigate this, or at least they give us kind of wisdom on how to navigate it compared to, a lot of, say, money managers looking at 20, 30, 40-year back tests on things that kind of is a very niche environment, very specific environment, whereas some of these more unusual decades require kind of a longer time frame to look at.
So from a macro perspective, what are some metrics that you follow and what are you seeing coming up into this environment that we're seeing maybe from a couple of years ago or today forward? Are we seeing an inflationary environment and are we looking at a new paradigm?
So I think that following inflation and disinflation are some of the key things to monitor. And so there's a couple things that I look at both the supply and the demand side characteristics for that. So one is that I look at what's called the long-term debt cycle, which is, most people are familiar with the short-term credit cycle, the 3 to 10-year business cycle where you build up debt during expansion and then there's some sort of deleveraging event, some sort of catalyst. But the way that kind of modern central banking works is that you don't really deleverage all of that. When you start to deleverage it, they come in and they cut interest rates, they do fiscal policy, and they kind of get that credit building up again. And so you never deleverage all the way back down to your starting point for that cycle, or at least you rarely do. And so you end up building up higher and higher debt to GDP and lower interest rates. So instead of looking like a sine wave, it's like an upward sloping sine wave. You just keep getting more and more debt. And eventually that hits zero. You hit zero interest rates, and it's hard to keep maintaining that higher and higher level of debt. And eventually, that'd be considered the long-term debt cycle. You kind of run out of room on that existing policy framework. The last time policy rates hit zero was back in the early 1930s. And then went through a long stretch of positive rates, and then we hit it again in 2008. And so those two periods are kind of the beginnings of a long-term debt cycle unfolding. And these tend to happen in kind of two phases. The first is a private sector deleveraging, which is a rather disinflationary period. And so that's why, the 1930s, you had a lot of destruction of money because you had no FDIC insurance, banks went bust, people literally lost their money, M2 supply, broad money supply literally went down. And then in the global financial crisis, it didn't go down because, we printed more money and we have kind of safeguards against that. But if you look at broad money supply, it didn't go up during that period. At least it didn't accelerate. It just kind of kept going up at the same rate that it was. Fiscal policies kind of increased money supply a little bit, but it was offset by some loan destruction. And so broad money supply didn't do anything remarkable. Only central bank balance sheet based money did, but not the broad money supply that you and I hold in our accounts. And so those decades are rather disinflationary. And then I know you've done work around the housing cycle, so that was a very, after so much overbuilding, that was a massive kind of a disinflationary period for the housing market for a while. And then the second part of a long-term debt cycle unfolding is that in response to that massive private sector deleveraging, the public sector starts leveraging up. Basically, they find that that isn't, kind of intolerable. You get rising populism. It's that they kind of, they might attempt austerity for a period of time and it stops working. And so they end up going through a period where they radically expand the fiscal stimulus to try to offset that. Now, in the 30s and 40s, you had this long disinflationary period. You had rising populism in Europe and the United States, and eventually led to war. And that's what kind of sparked the fiscal injections everywhere. Whereas, of course, in this environment, we had this kind of disinflationary environment. We had rising populism in most countries around the world, and then you get a catalyst of a pandemic, and you just get massive fiscal stimulus against a really leveraged economy. And so this time, unlike 2008, we had a massive increase in the broad money supply, right? So helicopter money going out to people. And so that prevented a lot of deleveraging from happening, but also resulted in more money chasing more goods. And so my overall view is that essentially long-term debt cycles are more often than not resolved by the amount of currency in the system going up, more so than actual deleveraging. And so that's where you get that more inflationary environment. The other cycle that I watch that goes along with that is the natural resources cycle, because it's a naturally kind of a boom bust cycle. You have periods of oversupply and undersupply. And so when you have oversupply, you get very cheap commodities, and then nobody wants to invest in those commodities. Eventually, demand keeps ticking up over time. Existing supply gets exhausted. You reach a tipping point, prices start going up. And of course, developers come in, but with a lag, it takes time to bring projects online. So you overshoot in prices, you get a more inflationary environment, but then enough capital comes in, they overbuild again, and then they push that cycle over. And so when you kind of map out, expansionary fiscal monetary policies, kind of the money supply with that natural resource cycle and other sort of resource constraints, could be labor as well, looking at labor constraints, trends of globalization, you can put those two together and generally get an inflationary or disinflationary forward guidance. And so my overall base case is the 2020s are looking notably more inflationary than the 2010s. But that doesn't mean it's going to be a straight line. So maybe we can talk about different timelines. But overall, I think we're in a structurally inflationary environment, even though maybe in the near term, I think we might, kind of be hitting a disinflationary period within that inflationary structural environment.
So when you say inflation, when I think of inflation, I think of an increase in money supply or a leveraging up of credit. So where is that inflation exactly coming from? Are you saying it's more fiscally driven, or do you think it's more from loaning driven, or both?
Yeah, so there's two main types. There's fiscal and loan driven. And so if you I have a chart that if you map it out over like a century. So for example, in 1940s, you had a huge boost in money supply, and the vast majority of it came from fiscal expenditures. Bank lending didn't go up a ton. Whereas in the 70s, you did have some fiscal obviously going on in there, but the vast majority of it was bank lending, and also the decades leading up to the 70s. So it was a very bank lending heavy, loan heavy environment. Basically had a demographics bulge related to housing and other demographics trends there. So what we're seeing in say 2020, 2021 was mostly the fiscal. So banks weren't, they weren't destroying loans in the same way that they were in the early, in the 1930s or in the 2008 period, right? So there wasn't really loan destruction, but they didn't really have loan creation either, other than, around the margins with, PPP loans that turn into grants and things like that, revolver credit. But for the most part, there wasn't a lot of bank lending. It was a massive jolt of fiscal stimulus. Now that's starting to wane, which is part of the reason why I think that, we're kind of, maybe looking for a near-term peak in year-over-year CPI. But I think longer term, I think bank lending is going to pick up to some extent, and I also think that fiscal stimulus is going to have further rounds later in the decade, and that we're kind of in a structural fiscal deficit environment anyway. And so I think that it's going to come from a little bit of both, but I think the fiscal is going to play a pretty large role going forward.
Yeah, I completely agree, 100%. So looking at interest rates, and if we're going to have this inflation, what's going to happen with interest rates? Are they going to hold it down? Can they hold it down? Are they going to naturally move higher? The 10-year treasury bond is kind of what I'm thinking. Is it increasing interest rate environment or a flat interest rate environment? And kind of where do you see the dollar playing with this as well?
So my base case is probably flat and choppy. And the reason for that is I think you're going to decouple from inflation. We already have. I mean, if you ask people a couple years ago, if you have 7% official CPI, probably higher than that in terms of real inflation, what would the 10-year be? Few people would say below 2%. But that's where we find ourselves today. And I think there's a bunch of reasons for that. So if you look at the 70s, that was a very inflationary environment, largely driven by bank lending. And you generally had rates, both the central bank was trying to, raise interest rates on the short end to keep up with inflation, and you had the long end generally keeping up with inflation over time. Whereas you look at the 40s, you actually had higher year-over-year inflation at one point. You had 19% year-over-year inflation on average. Inflation averaged about 6% for that decade, from the 40s going into the first couple of years of the 1950s, and yet interest rates were held at zero roughly. And the 10-year was pegged at around 2.5% for most of that decade. And so the big difference there is that in the 70s, they had low debt to GDP. They had already inflated a lot of debt away, more or less. And you had huge kind of real growth. You had loan-driven growth. And so when they were trying to combat inflation, they jacked interest rates up very high. And it put the economy into a recession, but it didn't cause like a massive depressionary like insolvency event. It just caused a severe recession, and that was able to stabilize the dollar. Whereas in the 40s, they couldn't do that because one, the spending was coming from fiscal, right? So it's not coming from bank lending. So jacking up the interest rate is not going to affect really the fiscal decisions. And two, they considered a matter of national security to hold interest rates low because you had very, very high federal debt to GDP, and they couldn't support 5, 10, 15% interest rates. So they basically just had to hold rates low artificially by pegging the yield curve, basically being willing to buy treasuries as needed to monetize them and maintain that peg. So I think my base case in the 2020s decade is that rates will spend the majority of time below inflation levels. Now there could be very brief periods of time you have a disinflationary period. Maybe inflation comes down and you have positive real rates for a period of time. But I think we're going to spend the majority of the decade probably with negative real rates. And it's partially just how much debt is in the system, how much, there's different sort of mandates for different pools of capital that have to hold bonds. And then they also, they basically kind of engineered, I would say, kind of like yield curve control, but less explicit than what they did in the 40s, kind of a more sophisticated form of yield curve control that is basically a form of financial repression, basically holding rates, cash, and treasuries well below the inflation rate.
So if they are successful at holding rates down similar to the 40s, and I know back then we had kind of a gold standard and gold wasn't freely, traded. What's that going to do to the dollar, and how is gold going to react? Is all the pressure and we'll call it pressure, is it going to build up on the dollar then, where the dollar could head quite a bit lower? And then we'll start to see all these commodities or precious metals or whatnot move on higher. Where's the pressure going to build if they're successful at holding rates down, having inflation run, and having a very large real negative yield?
Generally, real assets, with the caveat being as long as they're not already very overvalued. So basically, any sort of appropriately valued real asset should do well against fiat currencies. How well the dollar does, it partially depends on what you're comparing it to. So, right, if you're looking at, say, the dollar index, you're comparing it to a basket of other currencies. I am generally bearish on the dollar longer term, and that ties into the fact that we have certain advantages, but we also have some disadvantages, like a structural trade deficit. And so, there was a long period of time where, like basically we run these structural trade deficits. Other countries come in, they take those dollars and they buy our treasuries with them. They basically, for their reserves, for their pensions, for their sovereign wealth funds. And they started to slow that down back in 2014 or so, especially China. And then instead they started, many of those places started investing in our equities. And so a lot of capital flowed into our equity market, but those valuations are very, very high now, especially without interest rates continually going down. And so a lot of the juice has been squeezed out of that trade. And so we're starting to see a little bit capital flow back into treasuries, but I don't think it's enough to really fully replace all the capital that was going into our equity markets. And so I can foresee basically at the current time, the way I've described it is like a capital sponge. We've kind of spent 40 years of structurally declining interest rates and maintaining this petrodollar system that kind of, forces our trade deficits to open up, puts a lot of this capital back into U.S. capital markets, and everyone's kind of on one side of the boat now. So everyone is, very overweight the U.S. Americans are very underweight foreign equities, like they have among the lowest allocations they've ever had to emerging markets, and everyone's kind of stuffed into U.S. equity markets. And if they decide to just kind of moderately lower that allocation due to, maybe valuation concerns or just being so overweight, that can result in capital outflows out of the dollar. And so I am somewhat bearish on the dollar versus some of the other major currencies, but I think that's kind of a race among losers. Like I think, it's the bigger thesis is that real assets should do better, should do well in fiat currency terms, I think, over the course of this decade. So that'd be the commodity area. Real estate's interesting because if you look at most markets, a lot of them have really expensive real estate markets, like say China, Australia, Canada, parts of Europe, very expensive real estate markets and not very expensive equity markets in some cases, whereas the United States is the opposite. Our real estate market, there's some areas that are very hot, other areas are somewhat appropriately priced compared to international markets, so at least on a relative basis, and whereas our equity markets are extremely expensive. So I think the combination of certain areas of real estate could do well, or at least well enough on, compared to other alternatives. And then I also think that commodities and real assets are pretty well positioned. And then exactly which ones depends on where the demand is. So I think industrial commodities are going to do well. I think energy is going to do well. I think, gold is probably going to do well. There's some, central banks still hold a lot of gold. Some of the retail industry has gone into Bitcoin. There are funds out there like Incrementum that say have gold and Bitcoin together in a fund. They're kind of these alternative monies that people can get into. So I think that having a broad outlook on all these different assets is probably at least the way I'm playing it.
Yeah, that makes a lot of sense. When you look and evaluate these sectors, you're saying a lot commodities and precious metals and whatnot. What's your approach to evaluating these things, and how do you value them? So the evaluation or valuation aspect, what are you looking at?
So it depends on the type of market. So I would separate commodity monies from industrial commodities. So, I analyze gold very differently than I do oil, for example. But with industrial commodities, I generally look at supply demand characteristics, basically. So the 2010s were characterized by oil oversupply. The shale oil patch brought a lot of new supply online. Most of that was free cash flow negative. They basically destroyed capital, but it flooded the market with supply. And now there's that regime is kind of shifted. Basically, pensions and other large pools of capital are, one, they're tired of lighting their money on fire, and two, they have ESG mandates now, and so for better or worse, they just don't want to allocate to them. And so those companies are kind of forced to be more free cash flow positive. Like they if they're going to do capex, it has to mostly come out of their own financing. And years ago they got rewarded for talking about growth, and now the CEOs get rewarded when they talk about having a high hurdle rate for growth and instead dividends, share buybacks, debt reduction. And so that's a general trend we're seeing. And so I generally look at that overall characteristics. I also kind of look at ratio charts like the S&P 500 as priced in a basket of commodities or priced in a specific commodity, and look for momentum rolling over. So I might have a thesis that say oil's cheap, but I also want to see a catalyst. I don't want to see it going straight down and stocks are going straight up. I want to see it start to go in that commodity's favor. And so that's how generally I analyze industrial metals, is really looking at supply demand situation. For gold, I do it a little bit differently because there's no firm source of, there's such a high stock to flow ratio that the supply demand is not the key thing. It's basically what sort of environments make people want to buy it. So gold has a couple in correlations that are important. So one is it tends to do better in environments of negative real rates. Especially on the longer end of the curve, because it's considered a long duration asset. And so basically what the long rate is doing compared to inflation. And then in addition, because we often think of gold as priced in dollars, if the dollar is, particularly weak against other major currencies, it tends to be a positive gold environment. And then just in addition, you can look at, say, the broad money supply over time. And then you can look at, say, the market cap of gold over time. A lot of people like to do gold versus money supply charts, but the issue that leaves out is that gold does have a small inflation rate as well. Basically, new gold is added to the mix. And so I adjust that for gold has approximately 1.5% annual inflation rate, more or less, between 1 and 2% per year. And so I add that over time, and it makes somewhat of a difference. But basically, I look at the market cap of gold compared to some of the broad money supplies out there, and kind of come to different ratio assessments.
Yeah, one thing I noticed when I looked and evaluated gold and analyzed gold is gold does very well when it's cheap in relationship to, say, the monetary base. But when interest rates, when you have high inflation and interest rates start creeping up, it seems like that increase in interest rate basically stirs the rotation of money out of stocks and bonds, and it chooses to go into, say, something like gold, precious metals, or commodities. It puts action into investors to say, you know what, I'm losing money on my bonds if I hold it with an increasing interest rate environment. So long that you have a real negative yield and an increasing interest rate environment, they're more likely to sell their bonds or stocks and put it into precious metals or commodities, because it forces them to do something. If the Federal Reserve is successful at holding the rates low, and then they've got a high inflationary environment, do you think we're still going to see that money rotate into other assets, just based off of inflation? Or do we need the kicker of the interest rate to come on up?
So the short answer is I don't think you need it. The challenge is that the only environment we have for that is the 40s, and gold was pegged to the dollar and illegal for Americans to own. So we don't have a great data set there. The one way I would describe it is that even if interest rates stay flattish, basically the valuations in equities are such that they've really benefited from this 40-year trend of lower and lower interest rates. And so if they merely go sideways, and sideways can have a pretty big range to it, right? So you can be up a couple, 100 or 200 basis points. You could be down again, depending on these kind of these cycles we go through. I think the mere fact that both bonds and stocks are no longer benefiting from a structurally lower yield and decreasing yield environment is probably enough to rotate into gold and commodity markets more broadly.
Yeah, that's good to hear, because that was always one of my questions that I have in the back of my head, because usually I think of interest rates forcing that move. Right now, if you're new to the sector or you're new to investing, you're coming in, and let's say you haven't invested a lot of money, what are some of the best opportunities right now, in your opinion, for sectors and whatnot to look at this time right now?
So I think the challenge right now is if you look at purchasing managers indices over time, that kind of gives you they tend to go in these roughly 3-year cycles where you have a period of acceleration or deceleration. And for people that are familiar with them, basically if it's over 50, things are expanding. If they're below 50, they're contracting, but it also gives you a rate of change signal. So if you go up to 60 and then you're coming back down to 55 and 50, you're still positive, but you're decelerating. And a lot of markets work in rate of change terms. And so if you look at the PMI over time, it's this sine wave with occasional spikes or up or down based on big crises like 2008 or 2020. But for the most part, it goes through the sine wave. And so, for example, in the 2017 period hiking cycle, that was a rising PMI environment. You also had upcoming tax cuts that were about to happen. So the market was rather bullish. You had equities do well. That was a big Bitcoin bull run, for example. Generally, any sort of risk asset did very well. In late 2021 and early 2022, we see PMIs are rolling over, right? So that's generally a more challenging environment. It's kind of similar to late 2018 and into 2019. So all else being equal, that is tends to somewhat benefit, say, gold over risk assets. Now we've already seen a big drop in some risk assets. So I mean, it's ironically some of the things that ARK stocks, like unprofitable growth stocks, have already bled out 50 to 80% over the past year. I think probably some of them, I think there's probably some babies thrown out with the bathwater there. I think there are probably some that have network effects and could rebound from here. So I think there's rubble that people can sort through. Bitcoin had a big correction, so I think some of those could bounce pretty hard. But overall, I think that generally, I think we're in kind of still looking at a risk-off environment for 2022, at least until I see some sort of catalyst that would change that. And so I think generally gold is attractive. I think if you look at equity markets, I think some of the healthcare dividend stocks. I think some of the energy pipeline companies are interesting, right? Because they're less
Mhm.
tied to the price of the commodity and they pay very high yields, and they're generally undervalued just because there's not a lot of large pools of capital that want to over own them, partially due to ESG mandates. Um, and so those, I think those are some areas that are interesting now. But looking at longer term, I think energy producers, I think commodity producers, I just have a little bit of a caution here in 2022 because I see us kind of going through somewhat of a kind of a longer term risk off period. And I don't know if that could mean that stocks chop around sideways for a year. Could mean, some people calling for a crash. I mean, we've seen some early volatility this year. I don't have a
Mhm.
specific view because it partially depends on estimating what policymakers are going to do in response to things. But generally, until I see catalysts that suggest otherwise, I have a somewhat defensive outlook.
Yeah, the one thing that I noticed, and you've mentioned it earlier today, is you said you've got the fiscal spending. They've stimulated a whole bunch in the beginning, and then you're going to get this lull between the fiscal spending and then the lending, which we've got a large real estate shortage in real estate, and that lending from the housing starts coming in. I don't think has fully kicked in yet because it's usually a 2-year delay for inflation to kick in. So there could be a lull between that stimulus money and the lending money, so to speak. And I know a lot of people are really afraid of a crash, and it's difficult to say if one's going to happen or not. So speaking of crashes and whatnot, and being on that topic, how do you manage risk, and how do you position size your portfolio? What does that look like for perhaps maybe a new investor who's coming in here and looking at things? How do you manage risk?
So one is I maintain some cash and short-term treasuries and tips just for dry powder. So even in environments where I think they're losing value slowly, I generally want to have a non-zero amount of that. And how much I have will depend on how exuberant valuations are and sentiment is and other assets that I want to own. And so I sometimes joke that the dollar is technically the only speculative asset that I own because it's the only asset that I hold that I know it's going to lose value, but I hold it in case we get major volatility events and I want to rotate into things I actually want to own. And so I use that as somewhat of a volatility shock absorber. Um, you can also do kind of, targeted things. You can buy puts. You can go long volatility as kind of these defensive hedges. It depends on how kind of like if you're a portfolio manager that's the mark to market every month, right? You're more concerned about volatility. One of the few advantages that a retail investor has is that you can have a longer time preference. You can basically measure return increments in like 3-year chunks, right? So you can say, I don't care what happens this month or this quarter. I want to, buy something that's going to be higher 3 years from now, 5 years from now. And so for investors that want to look through volatility events, I think it comes down to, you know, position sizing around the risk of permanent capital loss more so than just volatility. So a lot of fund managers think in terms of volatility, but if you're not leveraged and if you have a long time preference, I think that it's more about managing risk around the risk of permanent capital loss, which is different. It's related. I mean, things that have a higher risk of permanent capital loss usually have higher volatility, but it's not a one-to-one correlation.
Okay. And when you look at these sectors and you position size and all that stuff, do you use any sort of technical analysis, or do you use fundamental analysis, and kind of which one do you lean on the most?
I primarily use fundamental analysis. That forms the backbone of my research. And for some assets, I dollar cost average into them, so I'm not too time sensitive on their entry points. Um, if I make a bigger move or a more specific thing, I do like to see some degree of price confirmation. So I use some very basic technical analysis to look for, things that you can't guarantee something's a bottom or a top. But I don't want to buy a falling knife, for example. So if there's something that I think is fundamentally attractive, I'll look for signs that it's also stabilizing and turning up in price. I'll let other people try to catch the falling knife, and then when it starts to turn up, and I don't want to just buy a line on a chart. So I never just do technical analysis. I want to know what I own. So everything for me is rooted in long-term fundamental analysis. But it is nice to start seeing that price confirmation. So sometimes I look at things, just normally priced in dollars, but then I also look at some ratios, like what is the S&P 500 doing relative to gold? Is that momentum rolling over? Is it rolling up? And so I look at combinations of price charts and ratio charts that you know they don't guarantee that something's going to work out, but they help provide a catalyst and they help do a little bit of risk management for momentum.
And when looking at some of those charts, what are you seeing? Like, let's say the S&P 500 or Dow Jones in relationship to gold. Are you seeing them roll over? Are you seeing that kind of topping pattern?
Yeah, as of this moment, we have been seeing over the past couple of weeks of rolling over period.
Mhm.
The most notable one since the start of the, kind of going into the pandemic and the whole kind of, 2019 period. Um, that you can get fake outs on these ratios, right? So, I mean, we just had a big capitulation in the markets. I wouldn't be surprised to see risk assets bounce somewhat.
Mhm.
So it's something I continue to monitor. But combined with the rolling over PMIs and generally the risk off environment, kind of fiscal stimulus pulling back, I do think that overall makes sense to see some of these risk assets rolling over relative to gold. And it's still early stage. I mean, gold basically has been flat while the other ones have been, down. We're also seeing some interesting kind of U.S. to foreign equity rotations that I'm not sure they have legs yet or not, but it's something I'm watching. As I mentioned before, investors are kind of at record low allocations to emerging markets.
Mhm.
Um, and so we're starting to see kind of basically we had this kind of early kind of mini crash here in January in US stocks, but emerging markets held up much better, which is actually similar to what happened in late 2018. That was kind of a US focused market decline. And so we're starting to see similar action this time. That time it was kind of a fake out. It didn't really have legs to it. I think this one has a better shot of having, kind of a longer um, regime shift associated with it. But it's something I'm watching for follow through. Basically, the valuations are more attractive. It's under owned, all those foreign equities. But of course, you have risks and currency risks when you get into that environment as well.
Mhm. Yeah, every time I usually see a commodity boom, I see a dollar that gets weaker, and then with the dollar getting weaker, you're playing not only the foreign exchange, you're saying I can buy assets like emerging markets and get it under a weaker dollar environment. Usually that pushes those markets higher or pulls them higher, however you want to say it.
Yeah,
Do you think
a big factor, just it might answer your next question, but basically a big factor there is that emerging markets have a lot of dollar denominated debt. And so when the dollar is strengthening, either due to some combination of kind of just policies or capital flows, people assume interest rates are everything, but they're not. I mean, they're a key factor, but it's also capital flows. But basically, when the dollar is strengthening relative to their currencies, it's kind of like they're quantitative tightening, um, uh, but they don't want to be doing it, and it's usually during a recession. So imagine quantitative tightening at the worst possible time. And so that's why emerging markets in large part are volatile. And so it's they also, I mean, they are, now the majority of GDP, the majority of population, and the majority of commodity consumption worldwide. And so when they're being squeezed by a strong dollar, it generally puts them into recession or at least a slowdown. And so it hurts their commodity consumption. And so when you have a weaker dollar, it feeds on itself because in addition to commodities being priced in dollars, it gives some breathing room to emerging markets. It allows them to ease and stabilize more, and you can increase their commodity demand. And some of them have kind of China's more tech focused, so it's not even really kind of the same thing as an emerging market anymore. But for example, Brazil is kind of a classic emerging market. And if you look at its GDP price in dollars over time, it had this big decline in the late 90s and early 2000s, and then it had another big decline ever since 2014 or so. And these were associated with strong dollar environments and weak commodity environments. And so if you get a reversal in that, if you get capital flows coming out of the U.S. And into either emerging markets or into just other developed markets, at the same time as you have commodity scarcity, you can have a pretty explosive emerging markets move. So something I'm looking for. I think we're still kind of early signs. But for example, as the world kind of goes into a post-pandemic environment, and as you have some of this, I think there's a good chance of rotation, but it's still early days.
Yeah, I completely agree. And the way that I view this, and I look at ratios, I look at all this stuff, and I think that assets go up because of capital flows or money flows. If you see a strong dollar, what that does is it forces everybody to kind of buy USD assets. It gives people in other countries to come and buy American assets, and that's kind of what we've seen, I think. So all the capital flows into the American assets, so to speak. What I was wanting to see is a weaker dollar with increased interest rates to force all that money back out. Because if it forces it back out, you can buy the undervalued sectors like emerging markets and commodities and whatnot and have that money flow back into it. And that's where you get your gains. So what do you look at for exit strategies, or what do you look at for selling of an asset? Or is this something that you want to hold on, you buy, kind of a Warren Buffett approach and never sell it? I know that commodities and everything are kind of cyclical in nature. Kind of what do you look for maybe selling those assets? What's kind of at the back end? And I know that might be some ways away, but what are you looking for?
A combination of valuations and sentiment, and then some sort of catalyst that things are rolling over. And I don't always get it right. I mean, sometimes I hold things too long. Some things I sell things too early. I mean, everyone kind of has that problem. And so, you know, for example, I used to hold Apple stock when it got, in my view, overvalued. I sold it and it went up further. Whereas other ones, like say Microsoft, I kept holding for a longer period of time. I only sold that very, very recently when it started to show kind of price weakness right around what was the top. I mean, maybe looking back 2 years from now in this interview, maybe it wasn't a top, but for example, I did trim that one out. Other times I hold things a little bit too long. So for example, in August 2020, my newsletter, I talked about how I see basically gold being temporarily overdone, even though still being long-term bullish, because I saw basically real rates, at least measured by the tips market, were bottoming. And also at that point, I was doing some fundamental analysis on the supply-demand characteristics of Bitcoin. I was expecting a pretty big run, which Bitcoin was pretty cheap back then in mid 2020, and so I was kind of shifting that bullishness into Bitcoin. Now, I didn't sell the gold and gold miners, and I probably should have, because they went on to stagnate for a period of time. And so it's one of those things. Sometimes I identify things but don't really take action on it because I have that longer term preference. And then some of the moves last longer than I expect, or say I have a bigger price move than I expect, and end up wishing that I had taken action. And so but in general, what I do is I look for a combination of some sort of fundamental catalyst, overall valuations. So I don't want to own things that I think are fundamentally mispriced, even if I expect them to keep going higher. I start to get nervous at that point. So I want to own things that I think are fundamentally appropriately priced. But then, when they get overvalued and maybe start kind of losing momentum is ideally when I want to shift into other assets. So generally with equities, I have a long-term focus, because if I own a high quality company, I'm willing to own it through periods of being maybe mildly overvalued or undervalued, because I want to have this kind of tax efficient long-term compounding approach. Whereas commodities can be more boom bust. So I'm a little bit kind of quicker on the trigger finger in terms of maybe getting out of things that are overdone and getting back in. So it really kind of depends on the asset in question. But overall, I like to have a multi-year holding period for most of my holdings.
Okay, so you're not trading in and out. You're holding these things for at least a few years and maybe even up to a decade or so.
Exactly. Yeah. There are equities that I hold for a decade, and other ones that I might have an 18-month view. Generally, I aim for the 3 to 5 year target range, just kind of a full cycle.
Yeah, when you're saying the full cycle, you're saying like a business cycle or something like that, half of a business cycle. Yep. Okay. Is there any questions that I should be asking you that I should be asking? Like, is there something I'm missing that we should know as viewers on the channel?
I think we covered a lot of the big things. I think it's important to have humility in this environment, just because there's so many moving parts. I mean, this is a very complicated decade in terms of macro and valuations and capital flows, and a lot of things that people, it's I think there's that Mark Twain quote where it goes like, it's not what you don't know that gets you, it's what you think you know that just ain't so. And so, for example, people are assured that, say, if the Fed tightens, that means the dollar is going to strengthen. But it really depends on what capital flows do, right? So it's not just relative interest rates, it's also capital flows. And so one kind of catalyst I may be watching for is that the market has priced in so many rate hikes over the next 2 years, but they generally have historically had a tough time raising rates and tightening monetary policy into a declining PMI environment, Purchasing Managers Index environment, and that seems to be what we're entering. And so if they end up having to kind of not tighten policy as much as people expect, you can get kind of a pretty sharp downward move of the dollar. But if they follow through with those hikes, I think you could get kind of a stronger, kind of at least a stable or stronger dollar period than people expect. And some of these trades might take a little while to work out. And so I think that I'm still kind of managing time frames in terms of having a very long-term, kind of inflationary pro commodity outlook for the decade, while being kind of somewhat cautious around the margins here in 2022 and going into 2023, because you have kind of fiscal gridlock, as you mentioned before, kind of some of this bank lending kicked in. So I'm still kind of bullish on the home building area in general, but I think we could see a lull here, and we've already seen some damaging price action for some assets. I think that's going to be probably still choppy for the rest of the year until I see some sort of catalyst to maybe suggest otherwise. But everything's kind of probability focused in this business, rather than so many analysts or so many people are kind of sure of everything, and I think that's where you really run into trouble.
Yeah, and if we are entering an inflationary environment, and the channel is very commodity, it's pro commodity, pro precious metals, and I'd even look at like emerging markets and stuff like that, something that's non-dollar. In this environment that could potentially be coming up, how big do you think the commodity bull market could be, given the market conditions that we have coming up? Do you think it's going to be a very large one? Do you think it's going to be kind of smaller? Like, are we looking at something like kind of a 70s type movement, or more like a mid 2000s type movement, or something that's even different than that?
So it's a really good question. I don't have the answer. One thing I would say is that the world demographics are certainly a lot weaker in this period than they were in the 70s or the 2000s. So in the 70s, you had massive American demographics. That was kind of the peak. Baby boomers were buying homes. And then in the 2000s, you had the rise of emerging markets in China. Now we're seeing kind of Chinese population sort of peak out, especially the working age population. India is not really kind of big enough to kind of fully take that baton yet, but I think that's kind of a market to watch. Same thing for parts of Africa. And so I think that if we get that weaker dollar environment, and especially given the weak capex in the energy markets, I do expect a pretty big bull move. But I think that the major headwind is demographics. So I guess I would err on the side of maybe not quite as big as what some people are expecting, but still rather big. But there's a huge range for that where that could turn out, because you're measuring it in dollars, and dollars have no bottom, right? So depending on things that happen, there's no limit to how high something can go priced in dollars. So I think ratio charts, maybe you'll have, if you look at, say, the copper to gold ratio, you had a really big spike in the 2000s, and that was kind of the rise of Chinese construction. So I wouldn't necessarily expect a big spike like that again. So I think that some of those ratio charts maybe be a little bit more muted, but overall, it kind of depends on if the bottom really falls out of some of these currencies, or if you just go through a more kind of normal cycle.
Yeah, it's a twofold, I guess, question, because you've got the currency that it's being priced in, and then you've got the supply and demand worldwide. I always think, at least in my impression, was that we were kind of hitting an accelerated growth curve of the adoption of, say, oil and whatnot in some of these third world countries like India and whatnot. So I was, at least the way that I was viewing it, is it get a pretty good growth in consumption over there of, say, oil and whatnot.
That's certainly the bullish case. People have also pointed that out for China. I've seen analysts point that out for China, that so even though, for example, their demographics are topping in terms of total population, working age population, their per capita energy consumption is kind of hitting kind of escape velocity point, where you'd expect kind of a sharp increase. And same thing for India when it comes to copper, especially. And so I do think that if you get that weaker dollar environment, that is the bull case. Basically, I'd be hesitant to take, like, I always try to give conservative expectations, so I try not to forecast this utterly massive commodity boom. But I don't rule that out either, because if you get some of those full catalysts happening, if China and India and some of these other countries go full steam ahead, and some of their dollar debts, especially for, say, Latin America, if those get eased and you have somewhat of a demand boom there, then you get a pretty explosive environment similar to the 70s or the 2000s.
Yeah, and I know that we talk a lot about commodities. What are some other things that we should look out outside of the commodity arena that may perform quite well over the next decade or plus? that we could kind of buy instead of just going 100% in commodities and precious metals and whatnot? What are some other alternatives that you like?
So I think there are some value sectors. So commodities are very boom bust cyclical. During risk off periods, I think that there are healthcare stocks that are attractive. Some people like to go into biotechs. I have no edge there. I look at some of the dividend payers that I think are reasonably priced, and they could provide kind of a lower volatility diversifier. We talked about emerging markets. I mean, even stocks that are not necessarily commodity related, I think you could have banks do reasonably well in those environments because you have, if they get eased from their dollar, there's the strong dollar environment that we're in now. If their economies do well in a commodity boom, their banks should do pretty well. And so I think generally value, high quality value oriented type of equities. One of the ways I'd phrase it is that in the United States, and we've kind of monetized our stock market for lack of good money. Our money's, negative real rates. And so we just kind of shove money into indices. And so we've added a monetary premium to stocks. We basically made them rather expensive. Whereas if you look in value stocks, you look at international stocks, they don't really have that monetary premium. So I would describe it as finding any sort of quality cash flow business that doesn't already have some sort of monetary premium kind of jacking up its valuation. So I do think there are other sectors out there that kind of look reasonably attractive.
And then one last question here. As an investor, what are some mistakes that you made kind of when you were earlier in investing that you have now completely eliminated from your investing, repertoire? Like, what have you completely gotten rid of? Because a lot of people, we have a lot of new investors. They ask me a lot of new questions. What was some of the things that you had to overcome as a new investor that you kind of stumbled on?
I think there's no mistake I've totally eliminated. I mean, my approach basically, I've been lucky in the sense that I avoided ever making big mistakes. And so my mistakes were like missing opportunities and making a ton of small mistakes, which are fortunately some of the better mistakes to make. I think the one thing I changed the most is going back to our earlier point of I try to be more aware of catalysts now. And so I used to say, basically this is overvalued, this is undervalued, therefore I want to buy this. And I still do that. I still bias that way. But especially when I'm recommending an investment to other people, I want to see that it's starting to work, right? I want to see that there's signs of rotation. And so I pay a little bit more attention to not like deep technical analysis, but just signs that momentum is starting to go in that favor. And that doesn't mean, it could roll over again and basically do another leg down or another leg up, whatever the case may be. But at least it starts to go in that favor. So I think adding, somewhat of a confirmation of price action to my fundamental analysis has been probably the thing that that's been most helpful that I've changed over time.
Oh, that's a great response, because that's what I've added probably some 5 years ago or so, is that catalyst. I use technical analysis for it in ratios, but so thank you, Lyn. I really appreciate you taking the time to come on the channel. I know you're very busy. So thank you very much. If you ever want to come back on, the door's open here to come back on. I'd love to have you back on and get your opinion.
I appreciate
So,
that. Thank you for having me.
yes, thank you.